day. Ira Epstein with your metals market wrap-up, and this is for Monday, the 7th of October, 2019, getting on to 4:20 p.m. Central Daylight Time. So we had a down day in the stock market, a down day in the silver and the gold market. This is mild. At the end of the day, you were closer to $15 down in gold, and silver was down probably about 14 cents. So this is where the market was at 12:30 p.m., and that's when the settlement price is determined, but it trades to 4 p.m., so you get different range spreads. Dollar index up a little bit as we've got all kinds of nastiness going on in the currency markets as the world is waiting to see about Brexit, the world is waiting to see about U.S. trade, I think this week we get the FOMC minutes, so we're waiting to see what's going on there. And it's a hodgepodge. Where are we going with all this? Probably the biggest first event to me is going to be the FOMC minutes, get an idea who said what and where are they. As a group, they don't tell you who's exactly saying what and how did they vote. You don't get that either. You get the total, but not who did what. Then the other thing we're going to be watching is the Chinese trade deal. I'm laughing in a funny way, and it's sad. You know, I keep hearing the U.S. pulled out of Syria, and then I'm watching the president 20 minutes ago on a news conference, and if that's true, I'm shocked because apparently we had 50 soldiers acting as a police force. 50, 50, not 500, not 5,000, 50. And we pulled those 50 to not get them in harm's way because of what the president was saying. They weren't supposed to be there forever anyways. 50. And yet I'm hearing we're pulling out of Syria. I don't understand this, but that's me. In the gold weekly chart, you can see how the market's been dropping. Now this line can come up a little bit. We finished at $1497.70. We're still but $30 or so from the highest close the market made. That's not bad action. We're caught in this right here. I'm pointing to you, this 1540 level down to the 1462, and believe me, you're just caught in this right now. You're whipping back and forth. If you try to dissect it, here's how I would do it. The pattern is one of lower highs and lower lows, which is bearish unless the market gets back over 1525. That would alter the pattern that if you don't get down first to 1465, you're going to have a higher low, higher high pattern. So the definition of, as I created the swing line, is to give me an idea, the number that the market should not get through if a trend's going to hold. To me, it's the 1425 level. If you look at the 18-day average of closes, we've been fighting at it for 3 days in a row. Let's see if it was 4 with this day. Yeah, it was 4 days in a row. So we started hitting it last Wednesday. We've been hitting it each day since then, and the market is looking, as I call it, what can it do? Well, it answered part of that question because you do have lower highs, lower lows, and the bias is down. Bias is determined the relationship of price to where the 18-day average is. It's down. Where's potential support? One of the numbers could be the 100-day moving average. The other one could be way down here at 1369.10, the 200-day moving average, but they're well under the market. In front of them, you have the lower Bollinger Band. See these? These numbers are not parallel to each other. A Bollinger Band is an algorithm that is designed to keep the market trading within it 95% of the time, but often what you'll get is sideways action within it as the market coils, getting ready for another move, whatever direction that is. If the market gets over 1525.80, the first resistance is 1537.60, the upper band. And if it breaks from here, 1481.90 is the lower band, the support zone. Momentum is up. I have divergence in this market. Let's call the momentum flat. You could even do that if you think that it's now flattening out on you. So I have flat momentum, I have bias down, trend down. The bears are controlling the market for the moment, and what they don't want to do is see this market over 1525. In the GLD, the popular ETF, I have a higher high, lower low pattern, no trend. I've got a market that 4 days, just like the futures, hitting the 18-day average, what I call that line in the sand. It's from there, markets try to figure out what to do. Unlike the futures, there's no trend. The resistance is 144.08. Now, If the market were to get over this high, and it was back here at 143 and a quarter, that would give you higher lows wherever that low comes in and a higher high. If the market just drops from here, even if it gets to the lower Bollinger Band as defined by the pattern, you still have a higher high and a lower low. In other words, no trend. That could be a support zone. In GDX, the market's just sticking right here on the mining stocks, right at that 18-day average of closes. I'm going to repeat again. Take out this 2805. As long as you don't first take out 2714, you could have higher lows, higher highs, and turn bullish. What do the bears want to defend? Right what they're doing. This 18-day average not allowing that number to happen. If they can get through 2714, they're probably hoping the market gets down right here to 2624. What's the bigger picture? Is this really lower highs? I don't know. Do you see what happened right here? And I always tell you that sometimes you get what's called an ugly chart. We had on this day, right through here, you broke through this day's low. This day was an outside day up. When you have an outside day up, you should not take out that day's low within the next trading session or the one after that. In other words, 2 sessions. Now, if it's a 5-minute chart, it would be for the next 2 5-minute segments. This is a daily chart. When you do that, you throw the chart off, and the swing line gets thrown out of whack. And that's exactly what's happened here. The swing line is out of whack. It's really not a down line. I don't know what it is. So I don't know where we're at on this chart. I would say that the chart clears itself up if you take out 2714 and don't take out 2805, because then I could argue you've got lower highs and then lower lows, and the target, if it gets hit, I think the pros would take money off between the 100-day average and the lower Bollinger Band. Conversely, I think the chart straightens itself out to the upside. If you don't take out 2714 and you take out 2805, that would give you the bias up, the trend up, and you put into play the 2933 level. Momentum's already trying to point up. The gold-silver ratio has stalled out at the 85 level right now, but it's still over the 18-day moving average of closes, which gives the market a bullish bias for gold. So gold is still a bit stronger than the silver market. If we look at the silver chart, you can see you've got the pattern of lower highs. But I could also argue you have higher lows. Do you see that one? The legacy is the pattern began on this peak, came down, rallied, and then broke again. Therefore, I'm going to call it a downtrend. What the number is that you don't want to see taken out if you're bearish this market is 1784.5, and if you close over the 18-day average without taking out 1733 first, you could end up with higher lows, higher highs over the 18-day average, and suddenly be putting back into play the potential for the upper Bollinger Band. Let's flip it. Take out 1733, don't take out the 1784.5 level, and you put into play the 1705 level as the downside target. Momentum has gone, in this instance, flat on you. The bias is down and the trend is down. In the copper market, today the market washed out the bear play. How do I say that? If you take a look coming in, you had lower highs, lower lows. You've been running the lower Bollinger Band, and momentum started, it oversold, turning gradually up. If you take out 258.55, you break the pattern, and in place you'd put in higher lows, higher highs. It's just what the market did. This is not yet a bullish sign. This is a sign that the bear leg of this part is over in the market. The bias is still down, momentum is up, but the battleground's still this 18-day average where you've been fighting literally since early, let's call it mid-September. You've just been fighting that battle on rallies there. In the platinum market, if you take a look at momentum, both numbers today are under 20 on the close. They were both under 20 on Friday and both under 20 on Thursday. Therefore, until the red line closes back over 20, the market has what we call an embedded reading. It's converted from oversold to locking in a trend. The problem for those that are ultra bearish is this is pretty strong support. 871.5, the lower Bollinger Band in black, to 868, the 100-day average of closes. I'd use a lot of caution if the market gets down there. In the palladium market, all you've done is pull back to the 18-day average. Now, I can argue here that you have higher lows, but I could also argue you got lower highs in the process. And I can argue that you're overbought as can be. I think this market is pretty neutral right here. It's trying to make a determination what to do next. And boy, does that make sense going into this trade deal talk. We did sign a deal with Japan today, and that is a good sign for the U.S. We still haven't conquered the auto issue there, but it's a trade deal. Does it set a precedent for what we do with China come Thursday? That's what nobody seems to know. In the dollar index, the market has got a pattern of higher lows, higher highs. The charts just disappeared, so don't worry about that part of it. When they disappear, it simply means that it's 4:30 p.m. and the charting service wipes that out. Suffice to say, if the dollar takes out last week's low, be careful. You're turning the trend down at that point. You know, our good friends at Modern Trader, they put out what we call publications. And these publications, technical trading tips from the top pros. Now, we know they put out news articles, but this type of publication was a special mini magazine that they put out that covered in detail all these different parts. I laughed because when I was doing the previous video this afternoon, rules for bottom fishers. Let me give you my top rule. Don't do it. It's that simple. If you're fishing for a bottom, it could be that you're still in the trend. If you are, okay. But if you're fighting a trend, fishing for a bottom, something I'd watch. Optimizing stops, great articles, because you're going to be wrong if you trade a lot. Investing's different than trading. I hope you appreciate that. The articles look like this. And I think you'll find that they give examples, they explain these concepts. Pretty neat, and it's fabulous for your trade library. And yes, friends, we made this into a PDF so that when you get it, you can open it, read it on your computer screen, or you can print it out for yourself, and it is in full color. All you need to do is give us, go to our website, by the way, and go to free offers. You can give us a call. We'll be happy to help you and get it right out to you, or you can click up here to get this. I'm Ira Epstein. You have a great night. I will talk to you all tomorrow.